Okay, so I guess let's bring you here.
Hey, there you
Hey,
are.
Kyle.
Happy Wednesday. How's it going?
Good. How are you?
Doing amazing. Having a beautiful week so far.
Yes. Getting busy?
Busy and just a lot of good, exciting things happening. So it's a pretty cool time. Pretty cool time to be in the mortgage business. That's for sure.
Yes. Same here with the real estate.
Yeah, yeah. Never. Hey, I can see your camera just on your video. Just a heads up.
You say only my camera?
I think it's your camera. It's blue and black. It looks like it's almost covering you on the picture. It's really close to the camera. Whatever wherever you're. Oh, there it is. Whatever you just touched, that was it.
Yes. Good now. Thank you for helping me fix that.
No worries. I can still
It's
see it a
still
little
there,
bit, but
right?
not now. Oh, there you go. It's gone now.
Okay.
Perfect.
So we have a very interesting topic to talk today,
We do.
and actually, how I name it? I name it like unlocking the mortgage mystery, exploring the DU with Michial.
There you go. That's good.
So can you explain to us? I mean, not to just real estate agents that doesn't know, but also for buyers so they know this new. I mean, I don't know if it's a new tool, but you can tell us about it. What is that DU?
Perfect. Yeah. So we were talking about this last week, and we thought it'd be a great topic to talk about on our call today. So DU stands for Desktop Underwriter, and a lot of realtors understand that DU is important, but they don't quite understand how it applies to a pre-approval. And this is often, you can tell this often because a lot of times listing agents will ask for a copy of DU in addition to a pre-approval letter. And in their minds, I understand why they're asking, because they think that it's helping them to mitigate risk and ensure that the borrowers were properly pre-approved. But what a lot of times I think listing agents maybe don't fully understand is that DU is a tool that is used by loan officers, and at the end of the day, what a loan officer puts into DU directly dictates the results. So you put good information in, you're going to get good results out. You put bad information in, you're going to get bad results out. And a lot of times, loan officers, I guess the best way to describe it is, a lot of times, if you've ever had a deal blow up as a realtor, and maybe it was the last minute and things seemed to be going good, nobody was communicating, and then all of a sudden you get that dreaded phone call and the wheels have fallen off the bus. You can almost always track that back to a loan officer making a simple mistake related to guidelines. And I guarantee you that every time that ever happened, the loan officer in the beginning had a successful DU, or the other one is LP. We call them AUS, or automated underwriting. At the end of the day, that's the general term. But a loan officer is always going to have successful or approved eligible AUS findings when they submit a file to underwriting. And what they're submitting with that file to the underwriter is their version of the scenario. So if a loan officer believes that a guideline is interpreted in a certain way, and they enter the results of that interpretation into their system, and then they run it through AUS, if it matches the guidelines, then you're going to get an approved eligible. If later it's found out by the underwriter that the loan officer didn't fully understand the guideline, and in actuality the data that was entered should have been different based on the guideline interpretation, well, now all of a sudden AUS or DU gives you an ineligible. So it's just really important, I think, for realtors to understand that DU is not a good tool to use when trying to mitigate misleading and ultimately lead to disaster if they didn't know their guidelines up front.
Okay, I have a question here for you.
Sure.
What are the key factors that the EU considers when assigning a borrower's credit worthiness and ability to repay the loan?
It's a great question. So, on the surface, they look at the four basics. They look at credit, they look at assets, they look at liabilities versus income, which is your debt to income calculation. That's what they look at on the surface. Those are the four basics of qualifying for a mortgage. Now, on the undersurface, maybe the subconscious, you could call it, they're looking at other things that you wouldn't expect, maybe, such as payment history on debts, number of delinquencies, credit usage, number of credit inquiries, things like that. So there's a lot that goes into the algorithm that calculates whether or not someone is approved or not. It's really interesting in that it's not just they take the scenario and they match it up to the guidelines, but there is some higher interpretation of the borrower's credit history that's being looked at also. So it's interesting. You might have two exactly same scenarios, same credit scores, same loan, same property type, same loan. Everything is the same, and you run them through AUS or DU, and you get two different results. One would be approved, and one would be not approved or ineligible. And if you really dive deep and you try to understand what the difference is, it's those second level things that are looked at that made the difference, such as credit history. And keep in mind there are the two main loan types that we have are FHA and conventional, and I guess you could say VA also. VA and FHA, which are the government-backed loans, they're going to be a little more forgiving on credit history. They're more concerned about credit score and the other basic parameters. Whereas conventional, which is usually your best loan option, if you can qualify for it, conventional is not only worried about credit, but it's also very in tune to credit history. So a lot of times, not a lot of times, but sometimes we'll have a borrower that has decent credit trying to apply for a conventional loan, but can't get qualified through the automated approval system because of some not so great past credit history. So it's a pretty interesting system, but so I think, does that answer the question?
Yes, actually, I have another question.
Oh, good.
Let's see. Okay, in your experience, what are the advantage and potential challenges of using DU in mortgage underwriting process?
So I guess when you think about that question, understand that AUS is required on every loan. So whether you're doing even on non-QM loans and jumbo loans, almost always AUS is required. There are some exceptions, but few and far between. So what that means is that this automated underwriting system is something that will almost always be applicable on every mortgage that is done. So whenever a loan officer is doing a proper pre-approval, using the AUS system is very important to run it through to make sure that they're not having any issues on the front end. And so, all loan officers should be doing that. So, the question that you just asked was, are there any challenges? Well, there are challenges.
Yes.
Yeah, there are challenges because things are always changing with DU. There's always updates. There's always new guidance that's being entered into the system. It's one of the reasons why loan officers really have to do a great job of studying and doing their homework and keeping up with guideline changes so that they're aware of what may cause a client not to qualify. So I think the biggest challenges from a loan officer perspective is just making sure that you're keeping up with the guidelines, any changes, and understanding how DU works, not only with the basics, but with the sub-layer of credit risk calculations that it does also.
Okay, let's see. I have one more question here. No, the comment was like, I sell furnitures. Okay. Okay, this one. How does the DU evaluate borrower information and determine their eligibility for mortgage loan?
Yep. So it's going to look at the basic things that a loan officer puts into the equation. So it's going to look at some of the information that's brought in from third parties, like credit reports, for example. It's going to look at credit history. So it'll look at the credit report and look at payment history, things like that. So the information that's used to create a decision in DU is going to be primarily from the loan officer and what they enter into their system. So that'll be like what they say the income is, what they say that the assets are, and then the credit report. that is pulled from a third party, which tells us what their credit score is, what their debts are, and what their credit history is like. And those are the main things that are going to be utilized. Obviously, the property information too. So when you're under contract live, you'll enter that information in. If you're just doing a pre-approval, you'll just enter a TBD, to be determined, and then the basic parameters of what the borrower is looking for as far as purchase price, down payment, things like that. So information comes from a few different sources, but at the end of the day, it's the loan officer entering the information in that's most critical.
So what you recommend, like we should use this tool as a part of
Yeah,
negotiation?
yeah, that's a great question, Alex. So keep in mind, I'm not a realtor and I have the utmost respect for realtors. So I don't want to ever sound like I'm telling you how to do your job. So please take this with a grain of salt. But my advice is, if you're a buyer agent, I would always encourage you to try not to provide DU to a listing agent. The main reason why is, remember that DU does have some semi-personal information contained in it. It doesn't have social security numbers. It doesn't have birth dates. It doesn't have the really sensitive info, but it does have, addresses, full names, all credit history, the names of your accounts, how much you owe, what your balance is, what your payments are. It's got employment information. It's got a lot of pretty personal info that, even I personally as a client, if I was a consumer, I wouldn't want,
You don't
you
want
know,
to share it, of course,
other people knowing my
to
intimate
protect.
details of my business, So I would encourage buyer agents to always protect their clients' information and try to press back if a listing agent does ask for DU. And then this is what I would recommend you say. I appreciate why you're asking for DU, but remember, the main negotiating tool that we have as realtors for our clients is our real estate contract. So I would always say, go back to the real estate contract and use the tools within the real estate contract as your pivot points or your benchmark for how you should negotiate a deal. For example, if you're worried about the quality of the pre-approval, this is why a listing agent may ask for a DU, because they're worried about the quality of the pre-approval. Instead of that, why not just ask for a shorter loan approval contingency? That is actually something that's within your contract, and as a realtor, you're fully within your powers to advise your client to ask for that, because it's there, it's in the contract. So instead of doing the standard 30 days, do 15. If you want to be really aggressive and you have a lender like ReadyRate that's fast, do 10. Keep in mind that the loan approval does include the appraisal these days. So in the old days, a year ago or so, we could provide a loan approval without appraisal, and appraisal was a condition of a property condition. Today, it's included as part of the loan approval, but again, that's not a big deal. We get our appraisals back in 5 to 7 days, so a 10-day loan approval is super easy. But that gives your seller more peace of mind that they're going to be able to get to a solid, not a final, but a solid answer on whether or not this borrower is legit as quickly as possible. So that's what I would suggest, instead of asking for DU, is just use the power of your contract, your real estate contract, and you can get to the same goals. And you're not really asking for anything that's too personal or that really shouldn't be provided. That would be my advice.
Perfect. Thank you for your insights, Michael, one more time in this week in our mortgage series. It's
My
always
pleasure.
helpful for both sides, for people who look into purchase and also for real estate agents. It's good to refresh a couple things in the market.
Absolutely. Yeah. And we love supporting realtors and helping them be the best negotiators they can be. And it's critical. Remember, your mortgage partner in the real estate space is going to make or break your business. They are by far your most important colleague. And make sure you do your homework and find someone you can trust. And if you're ever searching for the right person, keep us in mind at ReadyRate.
Thank you. Thank you, Michael. Thank you one more time.
Great to see you.
Next time. Bye.